In today's video, we are going to talk about how professional traders evaluate and place trades based on fresh news catalysts. So stick around. I'm Steven Spencer, a co-founder of SMB Capital, a prop trading firm in New York City where we trade stocks, futures, and options. In today's video, I will walk you through two recent examples of large cap stocks that reported earnings and how we prepared to trade them. This video was inspired by a recent question in the comments section on one of our YouTube videos. So I encourage you to ask questions and share trading insights in the comments section below our videos. We all will learn more together. Here are the game plan notes from our AM meeting. The first stock we're going to talk about is ADB, Adobe. In the game plan notes, I usually offer a few levels of interest that are potential support or resistance. And I will also provide one or two highlights that caught my attention from their earnings release. In the case of Adobe, what caught my attention was the 25% year-over-year growth in subscription revenue. That's a strong number for a large cap stock. It is not unusual to see 20% plus growth in smaller companies. By and large, larger companies will have much lower growth rates, usually below 10%. But a strong year-over-year growth rate alone is not enough to give me a bullish bias on a stock. I want to understand on the higher time frame how it is traded prior to the earnings release. So the first thing I do is scroll back to a year ago to see where it was trading. I can compare how much the stock has gone up in the last year versus its growth rate to make an informed judgment whether large market players would be more likely to buy or sell the shares. Then I'll zoom in on a 30-minute multi-week chart to see how people are positioned coming into the earnings released. For example, I have a bullish bias on a stock and it is sold off hard prior to the earnings release. I would view that as another check in my favor, as many people who sold will likely have seller's remorse and chase the stock as it moves higher following the earnings release. As you can see in this daily chart, Adobe was only up about 12% from last fall's high, and therefore it makes sense based on strong year-over-year growth that it would be trading higher. One of the things that I mentioned in our AM meeting while we discussed Adobe is that if a stock is behaving in line with how my analysis indicated it should be trading, there will be good risk-reward trades, but nothing great. In the case of Adobe, it is acting in a way that I would expect based on strong year-over-year growth and the gap higher, so there will likely be a good opportunity to trade it, but only what I would consider normal risk-reward and nothing earth-shattering. As you can see from the zoomed-in 5-minute chart, Adobe traded up to 317 after the market closed and reported earnings. The next morning, it's trading above 312 in the pre-market, which you can see on the right side of the chart, which was above the pullback low in the after hours. So from a purely price action standpoint, we would consider this moderately bullish. If we look at the game plan notes, you can see I've highlighted a few potential support areas and only a single resistance area, which was the after hours high. When stocks are at their all-time high, there are no resistance areas other than where the stock trades after the catalyst initially in the after hours. My expectation, based on the higher time frame chart we reviewed and the size of the positive catalyst, and additionally a ton of upgrades that we saw, worst case scenario is the stock seems to see some profit taking right on the open, so trades down a few dollars, possibly to S2, but more likely it will trade only to S1 and then move higher through the after hours high of 317. We discuss a few of the possible trading patterns during the AM meeting. We do this very quickly as we need to discuss 4 to 6 stocks in about 15 minutes. The process that we use to identify these stocks is part of the 2-hour free workshop. I spend 30 minutes on stock selection, and we also discuss in detail 2 of the lowest risk, highest reward setups that we teach on our trading desk. So if you have not watched the free workshop yet, I highly recommend you check it out now by clicking on the link above or the link below. The second stock we're going to analyze is Costco, C-O-S-T. This is another large cap company with strong growth. So I'll go through the same process as we did with Adobe, identify the key support resistance levels based on recent price action, develop a bias based on the higher time frame versus the size of the catalyst that we see. If we look at the daily chart for cost, we can see that on a percentage basis, it has gone up a lot more than Adobe in the past year. It's moved up from 240 to 300, which is about a 25% move. When we look at the morning game plan notes, we can see that even though it has strong sales and earnings growth, they don't look nearly as impressive as the size of the move that we saw in the past year. And this is why I'm interested in being short the stock. It's gone up 25% in the past year, but we can see sales growth 5%, earnings per share growth 10%. From a bigger picture perspective, this is a stock in a strong uptrend, and on the surface, the numbers look good. So my hope is with the stock opening lower, some people will initially buy it and it will spike up into an area, to our resistance area from the morning game plan notes, and that will offer us the best, most favorable risk reward entry for the stock. And if not, then I'll go to plan B and short at lower prices. I want to take a quick look at the multi-month 30-minute chart to highlight a couple of points. Cost has failed a few times, you can see on the chart, above 300 since September. And in the 2 weeks prior to earnings, the stock was bought in the 293, 294 area where it supported in late October and early November. This chart shows pretty clearly the plan B area to short the stock if we don't get it on our resistance areas right on the open. So if it trades down, not into resistance, we'll go to plan B. So you can see from the zoomed in chart here that the first move was down quickly. It flushed through S1 and then even S2. Because the first move is down, it is very low probability I'll have a chance to short it at my resistance area, so I go to plan B, which is to short it as it approached the earnings reaction low from yesterday's after hours trading. We can see that right there on the chart. It's around 294. And so as it pops up into that area, I get short. So you always got to have a plan B and usually a plan C. Stocks may go in the direction that your bias indicates they're going to go, but the path quite often will not be the most likely path, but will be one of several that you've outlined in your detailed game plan before the market opens. As I said here, we had to go to plan B. I want to give you an example of a stock with a negative catalyst that had a quick pop on the open where we actually were able to trade it into our resistance area. Here's the chart of HD. It popped right on the open into 232 and we got short. So we were able to short it on that quick pop right on the open. Most traders would view that as a riskier entry because we entered a position against the short-term momentum. But for experienced traders who understand the catalyst, as well as the key prices, entering against the momentum with a plan is a very effective strategy. But regardless, we need to prepare for many possible price paths for the stocks we're going to trade. So to recap for you, we identify the strongest points in an earnings release. We highlight them. The points that analysts and large fund managers will likely be focused on. Then we'll look at a daily chart to judge the longer-term price action against the details of the catalyst. And finally, we'll look to see how traders and investors have positioned themselves in the weeks prior to the catalyst's release. All of these things combined give us edge as discretionary traders.